Hopefully Matthew McConaughey doesn't sue me for that. The use of stablecoins in DeFi, decentralized finance. We haven't really talked too much about this, but it is a massive topic and absolutely an intersection to tokenized assets, and I'm very excited about this panel. We got a lot of heavy hitters. We got Nicholas Cannon from Gauntlet, the Chief Business Officer. We got Chen from Bitget Wallet, running partnerships. We got Sriram from Park 3643. Make sure you check out their awesome booth in the expo. Caroline D. Pham, she might not need any introduction to most of you, previous CFTC chair and now CEO of MoonPay Institutional. And last but not least, our favorite excellent moderator coming back for more, Alexis Johnson from Lightnode Ventures. Let's get into it, everybody. Your mic's there.
All right. Super excited to be here today for our panel topic focused on the use of stablecoins in DeFi. I figured we'd start off with some high-level brief introductions. And my name is Alexis Johnson. I'm the co-founder and CEO of Lightnode Ventures. We help companies grow and scale, whether it's commercializing technology, going to market, strategic capital. We scaled about 40 companies to date, and we're based here in New York City.
Hi, I'm Caroline Pham. I'm the CEO of MoonPay Institutional and also the Chief Legal Officer and Chief Administrative Officer of MoonPay. MoonPay is a crypto and payments technology company, and I'm proud to have launched MoonPay Institutional, which is our technology infrastructure platform for banks, asset managers, trading firms, and exchanges, looking to power digital asset banking products and services.
Hi, everybody. My name is Sriram with Park 3643, and we bring liquidity to real-world assets. We do that by separating the ownership status from the redemption claim. We can go through it in some greater detail. Nice meeting you.
Hi, everyone. I'm Chen. I'm the head of BD for Bitget Wallet. Bitget Wallet is one of the OG multi-chain wallet. Today, we support over 130 chains, serve over 90 million users. We also are the #1 RW trading platform on chain. We also offer API suite on top of our DEX aggregation infrastructure. Most importantly, we're building a next generation PayFi infrastructure that are serving the emerging market users, allowing them to deposit, transfer, spend in a very seamless fashion. And this is where we see the most opportunity in the next decade. Thank you.
Hi, Nick Cannon from Gauntlet. Gauntlet is the leading risk and optimization firm around since 2018 for DeFi, stablecoins, and increasingly real-world assets. We manage roughly 10 to 30 billion, depending on the day and the volatility on-chain, primarily around stablecoins.
Amazing. Thanks, everyone, for those intros. So to start off, right, stablecoins are often described as crypto's cash layer. But in DeFi, they play many roles, whether that's collateral, liquidity, yield generation. What is the most important use case for stablecoins in DeFi today?
I can take that one. I think historically, if you look at volume and you see the growth of stablecoins, it's trading and money movement or money in process of movement. There's a lot of bullishness around payments and use cases around there, but realistically, that's still single digits, and even where we're focused, credit and a variety of structured products and things like that, that's a fraction of that. The velocity of money and the velocity of stablecoins around that has been the driving use case, but still with the 10x forecasted growth from ECB and all the big banks, you can kind of expect, and definitely where we're betting is the growing use cases for money at rest. When it stops to slow down, when platforms like MoonPay or whoever else want to keep that, build out that user experience and give their users more options for besides moving the stablecoins around the global economy.
Yeah, I love this question because MoonPay really started in the DeFi space with non-custodial wallets. And so since MoonPay was founded in 2019, it's now expanded to over 30 million KYC users, to 180 countries, being able to do payments and settlements in 120 plus fiat currencies. And so this really underscores the use case for retail payments for stablecoins. And I think that is still a very compelling use case for stablecoins, because when you need to be able to trustlessly send money or value, cross-border in particular, and like the remittances use case, having something where you know that it's a bearer instrument, and when you are presented with it, you know that it's like $1, for example, 1-to-1. I think that's really, really one of the original and persistent use cases for stablecoins. What I also like, though, is in the institutional space, and we're starting to see this increasing this year. 2026, I keep saying, is the year of institutional adoption because of the regulatory clarity last year from the administration, from the CFTC's crypto sprint, which I led, and with the SEC. Now you are seeing the use of stablecoin as tokenized collateral. And again, this is where you need it to be a bearer instrument, you need it to hold its value. And in particular, when you are looking at anonymous trading, like in the DeFi circumstance, when you don't know your counterparty, you can't have any counterparty risk. And I think that's where stablecoin is also compelling.
Hi, we come to this from the world of supply chain and trade finance. There you have buyers who have basically payment guarantees, but sellers who need cash. And if you want to think about how this works on-chain, stablecoin becomes what sellers need, but buyers essentially need to provide some kind of a guarantee. So this is where the relationship between real-world assets and stablecoin becomes critical. And I think the infrastructure rails, where you have tokenization, the ability to collateralize, and have DeFi with stablecoins, creates this tableau of systems that allow for full trade transactions to happen.
Yeah, I think in terms of use case, no doubt today, DeFi trading, borrowing, lending are still the main use case for stablecoin. However, if we looking forward, we think that the payment is actually going to be the main driver of growth. We already seen data showing that for example, the B2B payment on stablecoin has grown exponentially, and more importantly, I think that the crypto is the promised crypto is to solve the payment problem, right? To begin with, but I think what really is going to take us to the next level or differentiate the stablecoin payment offering against the traditional payment offering, if you will, is the marriage with the DeFi, right? I think Nicholas mentioned that how do we introduce these earn product, right, through the payment approach, because we are targeting emerging markets. We see a lot of opportunities there. A lot of the users that are not crypto native today, but we want to solve their problem. For example, they're dealing with inflation. They're dealing with the daily investment opportunities that they are being deprived of, right? Because where they are. So we want to onboard these users through payment, but also more importantly is after they have crypto, and then they can also use them to make money for themselves, right? To thrive through our platform. So I think this is where we see the future main use case for stablecoin.
And building on that, stablecoins sit at the center of many DeFi market structures, whether that's lending markets, vaults, liquidity pools, on-chain yield strategies. And for Nick, from a risk in market structure perspective, where are stablecoins being used most effectively in DeFi today, and where are risks being underestimated?
I guess I'll start with the risk, because 8 years ago we started as effectively consulting and advisory a lot for consensus layers, and then a lot of the biggest protocols today. And we would always say, we only touch economic and market structure. You have to figure out Oracle and security and governance separately. And as those started to get built out and kind of commoditized, the risk that's largely underestimated, especially as we go towards real world or tokenized assets off-chain, is things we don't have visibility into. And it's the standard things that everyone would do credit diligence against. All the plumbing is there on chain, all the smart contracts. We can now see liquidity and depth and contract changes and all those parameters. But what we don't see is off-chain, and especially when these hacks happen or protocols blow up or whatever have you, it's the side letters and governance and foundations that are offshore that you find out as you try to do resolution and settlement.
And that raises the question of how users actually access these use cases. For many people, wallets are the main entry point to stablecoin activity, whether that's swaps, payments, DeFi apps. And for Shen, how are wallets changing the way people actually use stablecoins in DeFi?
Can you repeat the last question?
How are wallets changing the way that people actually use stablecoins in DeFi?
Yeah, so I think wallets playing a very important role in promoting the stablecoin, not just stablecoin, but all I think the crypto use cases, right? Because we are the portal, we are the first stop for the users. So I think today our key responsibility is about how do we improve the user experience by abstracting the complexity underneath the infrastructure, so that we can eliminate a lot of the fear of using crypto for not just for trading, but also, like I mentioned, for payment and other stuff, right? I think there is a lot of education that need to be done as well. I mean, not just by Wallet ourselves, we need to work together with our partner. I mean, going back to the example I use from emerging market, right? Like, when a user in Pakistan, right, they try to just do on and off ramp, right? And they will have to probably wait for a few hours sometimes because of some of the KYC process, right? Or some of the just unexpected frictions that happen. Then we as a wallet, right, we need to inform and also kind of guide them through the process. So I think this is very a real challenge that we are dealing with. And we believe that if we are able to kind of streamline the process and working with all suppliers and partners, and I think we will see a much bigger adoption for crypto going forward.
And as stablecoins become more embedded in DeFi, the risk conversation becomes more complex. There's a lot of different types of risk, whether that's depeg risk, liquidity risk, counterparty risk. For everyone here on this stage, what risk is the most misunderstood by either users or institutions?
So I'll take that. Are stablecoins stable? I guess that's the first risk. The reason that I think stablecoins need to be better regulated, and the Genius Act goes a long way there, is it essentially ensures that there is a single dollar in reserve for every stablecoin that's issued. When you have that kind of solidity behind the stablecoin, it reduces at least one type of risk, right? In the world of trade, where we come from, you have to think about payment guarantees, performance, and various other factors. There are lots of areas of risk there, and when you have 30, 60, 90-day payments, you have a number of things that can happen in that duration. However, from the seller's perspective, they need to put out cash up front, so stable coins have to be stable. Now, there are a number of other risks on the blockchain that effectively happen when you have loan protocols. We've seen some of the problems with, not with Aave, but the use of Aave. So there are different kinds of risks, even with stable coins, that one needs to be aware of, the peg risk and the, if you will, is there a there? So those are the kinds of things I think that I think all of us have to just be more aware of.
I think there are a couple risks that many have been mitigated, but there's still two that ought to be considered carefully. So of course, having the stablecoin one-to-one with the reserves is supposed to address market risk. Even having the stablecoins as a bearer instrument is supposed to address counterparty risk. But there are two risks that I think there could be more work on, and I think this hopefully will get addressed at the agency level. So one is addressing essentially the credit risk of the issuer. I know that some of the large rating agencies have been working for some years, and I provided some input into that on establishing ratings for stablecoins or stablecoin issuers. I still think that's an important thing that will be necessary, particularly when you consider sort of operational risk management and other requirements around the sort of stability or the resiliency of the issuer. I think The other one that is going to be important to think about is liquidity risk. And the liquidity risk is really if everybody rushes to redeem their stable coins at the same time, a classic kind of liquidity market stress scenario, where will we be able to, in fact, have somebody willing to take the stable coins and give you back treasuries or treasury money market funds? And so this is why in the past I have proposed that for central clearing houses, it would be good to work with the Fed and I think with other central banks on having essentially a standing liquidity facility for stablecoins for times of market stress, similar to during March 2020 with COVID, having the various standing Fed facilities for repo, money market funds, term loans, asset-backed securities, et cetera.
I love the liquidity risk one, especially on-chain as it happens, because before even like redemption or trying to get out of a stable coin, for all the leverage positions and credit positions and market making and trading that occurs, there's of course a lot of leverage around that. And even for issuers like Circle and Tether, there's new chains and new places to be. And very much, these DeFi Legos or these on-chain Legos that are quite composable really show their DNA in a market stress event like no else. T+0, T+1 block in 12 seconds can unwind quite quickly. So even ahead of genius considerations and legal considerations off-chain, those users who are using your stablecoin because you're Circle and you're public or whatever, you have the most liquidity, really are affected if that motion, wherever you're trying to deploy, as they still continue to do so on new chains like Tempo's incubated by Stripe or something like that, the motions there very much matter because the brand name doesn't necessarily carry it or solve for the liquidity risks that still persists.
And certainly one way to hedge risk, de-risk is provide quality infrastructure. And for Sriram, from an infrastructure and founder perspective, what still needs to be built for stablecoins to become more useful across DeFi? Is it better UX, better settlement, better compliance, or something else?
So there needs to be, I think, 4 different blocks of systems to make the whole transaction that we see that needs to happen. The first is you have to be able to tokenize real-world assets. Think of payables, receivables, inventory, and things like that, purchase orders that need to be tokenized. So there's a whole system that is sort of forming as we speak, where you have some underwriter, either an insurance company or a trade insurance group that provides a floor price. Then you have regulators that sort of work through what can be tokenized, and then these tokens are formed. Now, these tokens exist. There needs to be a way to take those tokens and bridge them across to the liquidity pools and the loan protocols. So there needs to be a mechanism there. So there are bridges, there are vaults, there are liquidity sort of, if you will, transactions that you need to sort of undertake to do that. When you have the loan protocols in place that allow you to effectively take real-world assets, I mean, 6 to 9 months for Aave to go through their governance is not really going to work for the world of RWAs. So there needs to be a whole new regime in place, if you will, a way of thinking about how you can sort of basket a number of these RWAs together. And then you get to the DeFi sort of world where you already have stable coins. And what needs to happen is cleaner, maybe seamless bridges between the world of fiat and the world of stablecoin. So if you see all of that, I mean, you're beginning to see the early stages of each of these pieces in place. You can sort of think of a future, maybe not too far from today, where all of that happens seamlessly in the background, and then you have ordinary 30, 60, 90-day transactions happening where payment commitments translate into actual payables.
And the infrastructure doesn't stop on-chain. And for Caroline, what role do fiat to stablecoin rules play in expanding the use of stablecoins in DeFi?
So I think having the fiat to stablecoin on and off ramps is going to be really critical because in order to really unlock all of the use cases for stablecoins in trading, you really need the cash leg to move 24/7. And That's where being able to have solutions, whether it's from pre-funding facilities or having credit facilities, I think it's going to be necessary to do things like enable further tokenization of real-world assets like securities. So for example, doing 24/7 securities, a tokenized fund like subscriptions and redemptions. That's one thing I think is going to be really important. It's also going to be interesting because until we actually have, from a regulatory perspective, the acceptance of stablecoins as cash equivalents, I think we're going to continue to have this issue because stablecoins remain the asset and you still have the cash leg that needs to be solved.
And that also raises a question about where innovation should happen. Where does stablecoin innovation in DeFi matter the most? At the issuer level, protocol level, the wallet access layer, or is it the fiat on-ramp, off-ramp layer in your all's perspective?
I think it has to happen on all levels, obviously, right? But I think first on the wallet level, I think we're more as a channel, right? Like for distribution. So for us, as I mentioned before, is that how do we bring user feedback, market feedback to the issuers, to the partners to help them come up with a better offering, right? For example, I talk about the emerging market where I think the type of stablecoin earn product they're looking for are different than the ones we're now offering to the DeFi or DGen people, right? Because they're just a beginner, right? They want something simple, right? It doesn't have to be a very high APY, but it has to be very safe and secure. Another thing, we also will have the responsibility to kind of help drive the innovation on the stablecoin. For example, today there are many stablecoin out there, right? But they're not equal. So one thing we are trying to do is how do we increase the utility of different assets through the shell of stablecoin, right? Of course, this is can be risky, but because we are also for example, promoting RWA, focus on RWA. So we want to see, our partners to come up with a solution, a stablecoin solution that will kind of bring this all together. So this is, my 2 cents.
We've seen a lot of inbound for FX stablecoins, Mexican peso, and emerging markets, and for us, not surprisingly, the innovation, or at least what they call on us for, is like, where's the demand? Ahead of like needing the pipes for on and off chain is like, why would there be demand on a blockchain for a Mexican peso or real or a yen or something like that? When in a lot of cases, USD stablecoins work, they're trying to hedge, users, investors, whoever, are trying to hedge their risks and their exposure anyways with stablecoins that are permissionless and cross-border, et cetera. So, we're often tapped to create the demand, create the carry trade on the yen or something like that, and then figure out, the rest of the pieces, which very much do matter to scale and get on and off ramp and be seamless with, us all here and real world economy and things like that. But where's the demand for these things is the open question we're always cracking our head against.
I definitely think there's more work to be done from a cross-border regulatory perspective around stablecoins. So until stablecoins are generally fungible cross-border, and until there is certainty in all different jurisdictions about the acceptance of them for payment or the acceptance of them for collateral purposes, I think that will still be a challenge to greater adoption. But I do think we are going to continue to see more and more foreign-denominated stablecoins being issued, sort of hand in hand with tokenized securities that are denominated in foreign currencies, and other development of the institutional markets.
So I think an area where there could be new innovation would be what we call trade tokens, where corporations could issue on their good faith and credit coins which are, quote, stable, not necessarily stable coin. Because I think something like that, like the old corporate script, is needed to be able to essentially lubricate supply chains. I think that's a little early days yet for that. Maybe synthetic stablecoins or something.
So, let's look ahead, right? If stablecoins were to continue to mature as core DeFi infrastructure, how will their use in DeFi look different 5 years from today?
I think you're just going to see more volume in actual stablecoins and more diversity. So again, more foreign-denominated stablecoins. It will be interesting because generally speaking, with new market structure, you see first a proliferation, and then you see consolidation. So it will be interesting to see what is the timing of that type of market arc.
So this is, out there, but Elon Musk states that labor is the constraint for goods and services. And with robotics, you have infinite labor with AI agents. If you have that, then you've got infinite productivity. Infinite is a big word, but you have a lot of productivity. And if you have a lot of productivity, then 5 years from today, stablecoin would effectively be, what UBI and all those other ideal models claim to be, could potentially sort of bring about to the global 8 billion an opportunity for, shall we say, redistribution of capital?
So I think there are two directions. So we are quite bullish on. One is we think in the future. I think again, right from wallet perspective, we want to abstract the difference of different stablecoin for our users, right? In the future, they don't have to know, like USDC, USDT, or some other. There's so many different stablecoins. Maybe they just need to know one. But of course, so underneath, they could be different stablecoins. So that is one. I think the abstraction to, especially when it comes to onboarding new users, I think that could be important, right? We already, I think, moving into that direction. That's one. Number two is that, as I mentioned, that I think stablecoin could be a very important vehicle for a lot of the assets that are not in payment, but they, this could help kind of increase their utility, improve their circulation. There's one project I've been heavily involved before, Bitget. That is, we work with Hamilton Lane and STBL and Securitize to create this private credit-backed stablecoin using the Hamilton Lane Scope token and the USDG. So I think that's a great example of creating the actual utility for RWA, the good RWA assets, while making sure that this is, for example, Genius Act compliant and also, sound and robust.
Yeah, I think just building off of that. So one of the products that MoonPay has is our stablecoin virtual accounts, which you can then link to a card to spend. And some of the work that I've been doing recently has been focused on financial literacy and financial inclusion, which I feel is a narrative that was very prevalent in the past couple years, but has not been talked about so much this year. And here, I think this is really important because what you're generally talking about, and again, this goes to how stablecoins can mitigate credit risk. You do have the underbanked or the unbanked who do not have credit risk, established credit risk. And so there is a reluctance, of course, to then be providing them with different financial products and services. But when you essentially have something that is like a prepaid debit card, that mitigates that credit risk. And so I think this is a great way to essentially expand access to subprime, what would be considered sort of the subprime segment or demographic. And I think this is something, when we think about the Community Reinvestment Act, we think about how financial institutions are trying to reach some of these underserved communities. I really think stablecoins as a vehicle for that is something that ought to be further explored, and I think there could be some really great initiatives to help to support that.
And as we look forward, right, it's worth clearing up what people may still be getting wrong today. And for those here on the panel, what is the biggest misconception about stablecoins in DeFi today?
Well, let me go with that. Today, we all think of USD as being the underlying currency for stablecoin. But I think that stablecoins could be stable in different currencies. And I think that the RMB stablecoin or the INR stablecoin will soon emerge, maybe.
I think there is still maybe a lack of understanding about thinking that all stablecoins are created equal, and they're not, because there is, under the Genius Act, there is a variety or a range of what's acceptable as the assets that are in the reserves for a stablecoin. So I think, again, this goes back to why it could be very important to have ratings for stablecoin issuers so people can better understand and differentiate between various stablecoins and the mix of assets that are supporting the reserves for that stablecoin.
Yeah, the ticker is very deceiving. USDX, YZ. Genius obviously helps here. I think, back to the previous question of looking forward 5 years, a lot of it is the blending of the UX, where you're basically just signing up. You don't know necessarily, or maybe you do or you don't, but like the blurred lines between custodial and self-custodial, between what chain you're on, what protocol you're on, what exact ticker that necessarily stablecoin is. You just know the currency you want to use and how you want to use it. How quickly you can go from a stablecoin to a card is now getting down to sub-block, basically from a stablecoin that is earning 12 seconds prior, some 5, 6, 7% yield, and then buying a coffee and sending a Visa approval. That next block is pretty important.
And as it pertains to tokenization, what are some of the most overlooked opportunities when it comes to integrating stablecoins and DeFi, in your all's opinion?
Most overlooked opportunities. I think RWAs are the beginning and the tip of this iceberg. It's like this massive gold rush. I mean, I keep hearing new ideas literally every day, and I'm like, oh, that could be a coin too. This could be a token too. So I'd say that RWAs were one of the most overlooked, and I think we are really at the tip of that iceberg there.
I think there's a couple mega trends that are coming together all of a sudden, and it is creating this opportunity that maybe not as many people are spotting or positioning themselves for, and some of that was alluded to with AI and robotics. So we have, of course, DeFi, decentralized finance. We also have DePIN, which is decentralized physical infrastructure. We already have Web3. We have the Internet of Things. We have smart homes. We have smart devices. Our cars are going to continue to get smarter as well. And so I think when you look at all of this together, you are looking at stablecoins really powering an agentic economy that is automated. So one of the examples that I love to give is, think about your fridge. If you have a smart fridge, and with AI and with a stablecoin linked card, that your agent can spend for you, which is another product that MoonPay has, your fridge can literally see when you are running low on groceries, use agentic commerce to then place orders for that on, like an Amazon, Fresh, and then pay for it with that stablecoin linked card. So I think we are going to see all of these things converging, and I think it's really going to change the way that we go about our lives and we live and work every day.
I'd like to add another, I think, area may be worth watching is the forex of different stablecoins, like between USD, let's say, and a Brazilian stablecoin, a Mexican stablecoin, because there is arbitrage opportunity when there's a yield difference, right? So you can, maybe you can collateralize your, let's say, your Brazilian stablecoin, which gives you, I think, 10% APY, and then you can borrow USDC at a lower rate. So and then use that to spend, right? So or do something else. I think that is actually an interesting area which I learned about. Just a few weeks ago. I think that could be interesting, right? Because again, right, this would all tie to the demand, the stablecoin demand from the emerging market, because even though there's a lot of people who want to hold US dollars or digital US dollars stablecoins, but still there are a lot of people who like to also hold their local stablecoin, and then they want to find a way to either to spend wisely and also generate better yield through this forex arbitrage.
Points and rewards programs. I think we all have miles and points of hotels and similar credit cards or otherwise that sit and accrue, and then we sometimes remember to redeem them or get frustrated when we can't. Stablecoins bring a lot of efficiency, and there's this kind of like disruption that a lot of these programs are going to have to do to themselves or get disrupted otherwise, but being able to merge these use cases of stablecoins and how quickly they can move and either accrue additional yield or add additional benefits on the back of these programs to help boost and bolster them, I think is very much overlooked given the size of that market and sector.
And very last question. Will stablecoin use in DeFi become more institutional or more consumer-facing, or both down the road?
I think DeFi started right from the consumer space, and so not that it's saturated, because there, of course, can be greater adoption, but I think a lot of those use cases in DeFi from a consumer perspective are well settled at this point of time. But I think really where we're going to see some transformational change, which you might not even see because it's under the hood, it's the pipes and plumbing, right, is going to be in the institutional space. And so that's something that's really exciting.
I agree. I think institutional is where the big adoption curve should be there. Consumer will follow. And then, as somebody was saying, it'll be ubiquitous in the next few years.
We are obviously we're primarily focused on the consumer side of things, but also at the same time, I think we need to bring the institution along and work with us to provide better products to the consumers based on a understanding of the local demands and and think that's going to really I think change the game, because I think we've been through the process of starting with grassroots, right, bottom up, and then now we have the regulation. We have more mainstream players entering, and now we start to see the blooming and thriving of the whole space. So I think that's going to be key.
It's definitely the arrow, like what we see from going fully permissionless consumer or anonymous user to hybrid models, permissioned and similar, is definitely the arc that is changing now and probably in the next year considerably more.
Awesome. We're exactly out of time, so thanks everybody in the audience for tuning in. Thank you panelists for contributing, and we'll leave room for the next panel. Thanks.
Thank you so much.
Thank you so much.
Thank you.